So welcome today. You're coming to a presentation for investment. It's an investment in Phoenix market, 160 unit condo fraction investment called El Cortez. So this is a slide that we have we're required to put up due to our lawyer tell us to do so. So you can kind of read through this. But basically, it's saying that this information that we're doing in the presentation considered confidential is solely for the use for prospect investor to determine your interest in Al Cortez. And this is a 506B, so therefore the opportunity is only available to sophisticated accredited investor that has a pre-existing relationship with us or any of the sponsors over here. And then if you don't, then you're likely going to be not in the right presentation. So, and then we also appreciate it if you can make sure that you do not forward this information to anyone else without asking us. So give us, let us know, and then we'll kind of take it up from there. It's pretty much it. And then like any investment, there's a risk. So what we have presented over here are, to our best knowledge, the researchers and etc. we did. And then it's a forward-looking projections and etc. So there's no any guarantees that we're making on these things. So anyway, once we get that out of the way, welcome today to our Al Cortez presentation. And we're actually really excited about this project. And this project is about a 160 unit. And we'll talk about a little bit later, possibly more. In the Phoenix market, in the hottest metro currently in the investment world for multifamily. It's in the middle of Midtown Phoenix. So today's agenda, we're going to go through similar formats as we always do. We're going to introduce the team, talk about some of the track record. We won't spend too much time on this. I think most people know us, so there's some some backgrounds in that. And then we're going to be talking about the market, specifically Phoenix market. If you haven't heard about it, it's a great time to kind of learn about it. We're going to talk about the properties, and then we're going to come down to final numbers, investor numbers, and what it means for you. And then the next step on how to invest. Great. So I like to kind of front load, and then we're going to have this information later on during the number section as well. But I want to just kind of highlight the investor returns over here, because oftentimes we sit through very long investment summaries and then totally forgot the objectives about investing. So the most important things to investors are, what is your return? So for this offer, we are actually crafted out 3 classes. And so basically, it's structured into class A, B, and C. And in the summary view, and don't worry about this, we're going to put that in the number slides as well. So basically, class A investors are what we call pref equity investors. If that term doesn't make sense to you, don't worry about it. Basically, the minimal investment is 75K in here. The biggest thing about the class A, it's a fixed annual rate return. So it's 11%. It's almost like a debt investing, but it's different. It's not debt investing. But the way that you think about it is, hey, I put this amount of money in, it yields 11% consistently on an annual basis. And we do distributions based on our PPM every quarter and starts distribution on month 7. But in reality, on our other projects, when we did this class, we start distribution a lot sooner, probably in month 3 or 4. And then subsequently, we do it every month. We try to do this every month. It's pretty much like a clockwork. So it's 11%. The key is fixed annual return. So you do not participate in the equity upside, but you have preferential treatments over all the other classes. So you are the first one in the sack. So as such, it's a little bit less risk compared to all the other classes goes behind you. So unless class A gets paid to satisfy that pref rate, the remaining of the classes won't get paid. So it's very compelling for a self-directed IRA because it's a fixed rate return. So based on our consultation with our 401k retirement expertise, there's no UBIT taxes associated with this type of investment. Uh, there's also, so unlike a debt investment, you are still equity investors. So you are going to participate pretty much a similar ways how Class B and C, the equity partner, is going to be invested, like participating in for the sharing of your depreciation through the partnership's K1 return. And so this makes it more attractive options to invest compared to debt investments. So let's say if you have a 11% debt investment that you're deciding between the investments, the debt investment is going to be taxed at an ordinary income rate. So let's say your effective tax bracket is 3%, you only net home 7%. Whereas this type of investment, you pretty much get your 11% back net. Um, and plus negative K1s possibly. And the cool things about this is that the depreciation, the K1s, if you took it, for a lot of people they couldn't. We're gonna talk about a little bit later. But if you did take it and you were able to take advantage of this, it's not that when you get paid out, you have to put, you have to do recapture. It's when we exit the projects that recapture kind of comes back. All right, so this class is 75% minimal. Again, fixed rate 11%. And then we have the B and C classes, and we know Phoenix is a very explosive equity market. And you're gonna see some slides later on. The valuation has been really crazy over there. Every 2 or 3 months, I go visit. And then every 2 or 3 months, the prices of the unit per unit goes up like $20,000 per unit. So it's been kind of really crazy, great run for us there. Um, so this is where the B and C are traditional equity classes. So you do participate in upside of the equity returns. The difference between B and C is the minimal investment is different. Minimal for B is 250K. The minimal for C is 75K. So the philosophy over here is that we want to encourage people to do bigger investment, because it's a pretty large raise, relatively large raise, at about 9 to $9.5 million range. So we want to encourage, like, bigger investors. So there's a fewer investors to manage for us. So as such, we're giving you, from the voting rights perspective, it's all 70-30 split, but at the back end on the equity split, the sponsors are giving 5% extra to the 5% extra split to the Class B investor. So that kind of translates to about 5 to 8% total return difference, in the net of the project. Um, Class B and C are both going to enjoy a 7% pref rate. And that means is until that, and it's accumulative until that percentage is satisfied accumulatively. The sponsors us is not going to get any pay out of that. And they do participate in the bonus depreciation, so our traditional K1 partnership return. Our estimation conservatively is at 40%. So that means if you invest 100K, you're probably going to get negative $40,000 back. Most time, it can be used to offset some passive loss, but it's subject to passive loss limitation. If you have a W-2, this really becomes very favorable when for real estate professionals, and who also actively participate in their own projects. So if you have questions around that, it's a very complicated topic. I have articles written about this. You can reach out to us, kind of get into more details on that. And so Class B investment total return we have projected as 105%. So Class C is 100% plus. And then you're going to see some projection underlining assumptions there, over the span of 5 to 7 year holding. And then the 5% extra, as you can see, there's a 5% extra for the Class B at the end. And then there's the investor IRR, which we calculate based off the 5 year holding. Great. So this is kind of like the word version of what I just described over there. So I think these classes are really, if you're interested into equity, you're taking on slightly higher risk than the Class A's, because Class A has higher priority than everybody else to be paid out, but more risk and more rewards. You're also participating more of that return through the form of equity. Great. All right, so we're gonna meet the team. I'm gonna skip forward to introduce my co-partner, Aaron, and then Anthony is gonna speak, and then I'm gonna come back to our slide and kind of give myself a little introduction over here. All right, Aaron, down to you.
Okay. Well, there are some folks who know me and others that don't. I am a physician part-time. I still do medicine 3 days a week, which I still enjoy. But for many years now, I've been heavily involved in real estate investing. And as you can see from the slide here, I've invested in over 1,000 units in markets like Texas and Atlanta and Florida and Oregon. And this will be my first actual property in Phoenix, although I've been certainly trying, like other people, very hard to land properties in Phoenix. And I've been a passive investor. My wife and I are now passive in 9 projects total, but also we've been on the leadership role in sponsoring these things now in over 300 plus units. And then I guess if we include the Houston deal that's just about to close, that'll go up to about 500 units where I'm also bringing investors along. And I do have a significant background in business experience along with just investing. Previously, I was a director of one of my imaging facilities, which had a multi-million-dollar budget, supervising over 15 employees. I've also known in the MD investment circles. I was a panelist at Passive Income MD back in 2019, where I was able to speak to other people about these syndication type investments. And really happy to be able to partner with Elisa and Anthony to bring this investment to you guys, because I think it's really a compelling story for a lot of reasons, which we'll bring up. Uh-oh. You're on mute.
You're muted.
Oh
You're
yeah, I'm
muted
having a little hard time going back to the slides. Sorry about that. I don't know how to
Oh,
rewind the slides. Anyway, it's never a presentation without technical difficulty.
there you go. And I guess I'll kick it over to Anthony.
Hello, I'm Anthony. I'm the owner and president of Avant-Garde. We're a property management company based in Phoenix. My family has been providing property management services to Phoenix since 1988, and I pretty much grew up in the industry since I was 13-year-old, from picking up trash to helping with the turnovers to becoming a property supervisor and one day owning my own company. And not only that, I have managed in Central Phoenix in the corridor where El Cortez is located for over 15 years, 2 different offices. So I know the area quite well, and this market has just been incredible. We manage about 2,000 doors right now, well over 50 properties, and it's been just a hell of a ride.
Thank you, Anthony and Aaron, for your warm introduction. For some reason, I cannot rewind the presentation, and I have no idea why. So I'm just gonna do an introduction for myself, and without jumping through the whole hoopla on this. So I'm Elisa Zen. I basically own and syndicated over 1,500 units actively in Dallas, Houston, and now like a Phoenix. So Dallas and Phoenix is our more established market. Houston is our new market. So we just closed our first deal over there. Well, we're closing our first deal over there. It's fully funded. So in Phoenix market, we have 5 projects in this area. Now we actually sold one, so one full cycle. And then another one is likely gonna sell this year or early next year. So we're evaluating on selling as well. We like Phoenix market very much because it's a very accelerated growth market. So allows us to kind of exit the deal a lot faster potentially. And Anthony Anthony actually manages 3 out of 5 properties that we own and manage ourselves. No, sorry, in Phoenix market that we syndicate, asset manage. And also, and he performs very well. We'll have some slides later on to kind of talk about that. And we have many long conversations, and because his track record with us, you know, and it's also his aspirations to become an ownership as well. So we're very excited to, you know, really form this long-term relationship with Anthony and include him on the ownership side as well. And there's some really big benefits on when we're doing this, essentially reaching a vertically integrated model. without having to create a PM company ourselves, and then kind of step into what Anthony has already put his sweat equity in, building up, something that is already working. Cool. So we want to just show a few assets over here. This is going to be included in the slide. We're not going to spend a whole bunch of time talking about ourselves over here. So these are properties that I own in Dallas projects along with my partners. So they are larger properties over there. And we also have a fourth partner over here who is not join us today because we did another webinar with him earlier, Lane Kawaka. Me and Lane actually know each other from 5 years ago, probably 4 or 5 years ago. We all both lived in Seattle before. We met on Bigger Pockets and then just kind of build a really strong relationships. And then Lane and I have worked on a few deals together, maybe 4 to 5 deals together. And then Ashley, Ling, I, and Anthony has worked on the one project before as well, on the syndication project in Phoenix as well. So these are Lane's asset projects. He wants to show these B-class assets, which is owned in, I think, Alabama or so. And then here are other projects we own all across, US over here. Okay, so I want to talk about a little bit about the projects that we own in Phoenix. This is our portfolios in Phoenix. As you noticed, majority of property is on the smaller side, although this Scottsdale and Rise on McDowell is a portfolio of 135 unit. I think a lot of our investors or participate in this webinar is actually investors from these deals, or in some ways that you're involved in that. So really glad to see you over here because obviously we're doing something right on this markets. These has been our best performing assets, in the whole portfolio across the country. Anthony actually manages this one, and this one, which went full cycle for us. And then these two are currently managed by another company. I think we're almost exiting on Rise, so there's no need to kind of switch these over. All right. So our strategy in Phoenix market, this is our sixth acquisition in this market. So really want to going after the B class asset. I want to kind of compare El Cortez with our property, Old Town 24, which we just own ourselves. And it's a really similar asset, as in it's an older product, but it's being renovated to a higher class. And in fact, El Cortez is one class higher, I would say, than Old Town. Basically, the property is in a really prime location. Old Town is at Scottsdale, Old Town, literally 2 blocks over, which makes filling the units very easy. And Anthony's team actually do a very great job in terms of leasing up and tenant management. So this kind of really plays into their willpower. So we're really going after the B class asset, maybe even B plus, and then we really focus on being in the good submarkets. Because during COVID, what we noticed is that our C class location properties, which we don't have too many anymore in our portfolio, but they tend to struggle a little bit more due to the lower income nature of the tenants. So they're more open to risk during a little bit more recession period. So using a conservative stand over here, we want to really focus on these B asset, and then really kind of creating a value in the A, B class type of asset, and really making us the value play into that, like a higher class tenant play. So want to focus on expense control because, guys, it's really competitive in like Phoenix market. So any off market deal or on market deal, you're not gonna get a huge deal on this. Sometimes the off market deal gets a bit higher than the on market deal because you gotta pay more to get seller to agree to sell to you before it hits the market. So basically we focus on expense control, and we also look at increased income, but more so the expense control is where we do really good, especially with Anthony's involvement as vertical management. want to really align property management incentives with our investors' incentives. So Anthony is getting paid on the general partner side. So if he performs well, ideally he should be making more, hopefully, than his PM charges with on the property like this. Usually it's at a 3 to 3.5%. But Anthony is giving away all that, and then he's only charging 1% on the property management fee, and that gives a huge margin of $36,000 on this potentially property. Don't worry, he is getting paid, but he's only getting paid when he's performing. So we think that is really good to align with our investors' incentives. And we also very excited when we kind of talk about it, Anthony, me, and Aaron, and Lynn talk about this. When we think about what is our kind of 5-year trajectories and etc., the vision that we paint for ourselves is that we feel like that yes, multifamily syndication is great. We also want to do something right, like just do the right thing when we're doing investment. The investments are the same, but we want to kind of focus on when there's opportunity, doing the right thing. And this has to do with building strong community for tenant retentions, providing some sort of educational resources our tenants otherwise may not be subject to, exposed to. And Anthony has a very strong background in community building because he actually also used to work in housing before. So he had all these resources, free resources to have to connect basically tenant with resources such as like financial educations and other community related education type of program. So we also want to focus on, because Phoenix has a lot of sun. So this is really exciting for me. Usually it doesn't make sense, but this project actually made a lot of sense with solar power involved. So want to kind of do the right thing, harvesting some green power opportunities when it makes sense to create a win-win situation for our investor. And then you're going to hear a little bit more on the business part of this. We also looking for, in Phoenix market, because it's such an explosive market, there's possibility to have a quicker exit or refinance in a growth market like this. This is kind of bonus in our underwriting usually. And lastly, we have vertical integrated team. We actually do this for our other markets, Dallas and Houston as well. Similar kind of structure there. And then we see that is really returning. And then I'm going to kind of turn that to Anthony to kind of talk about the numbers, right? So these are some numbers that he was able to kind of achieve on the expense ratios. And here's a reason why to vertically integrate.
That's exactly it. If you look at the typical expense ratios, a classic building will run your expenses at about 40%, and then a newly remodeled building somewhere in that 30% range. I think what you see here, if you look at like Rise at Old Town and the Harlow, where we have a deal on the management fee, and Harlow, I'm an investor in, and you can see that the expenses are quite a bit lower. And I think that's one of the keys to the success of the properties, that vertical integration.
Yeah, and also smaller properties are usually a little less efficient with expenses, but because these products, the Old Town and Harlow is a newly renovated product, very similar to El Cortez, hence, even though they're older building, the deferred maintenance is a lot lower.
Yeah.
All right, and here's a track record. I'm not going to go through them. They're in the slide just for your visual pleasure. So you can kind of go through this and just to see where our track records are, what current projects are doing, etc. We do have a couple of full cycle deals. You can kind of look it through that too. All right, so I'm going to turn over to my out-of-state investor, Aaron, to talk about, the perception of the Phoenix market. And for real, what are some job growth and how is the Phoenix market, why we love that market?
Okay, thanks. Well, I think it's why not to love Phoenix, really. As a lot of folks will know, and we'll see on some of these slides upcoming, what drives this as an investment in any multifamily investment, really, it's the supply-demand imbalance, right? And so it's what drives that supply-demand imbalance of units? It's because jobs and people, right? So if the jobs come, there are people that are there, and those people need place to live. And so Phoenix is a great example of in growth from people, from in migration from other states, and jobs that are coming there that are drawing those people. And so we can see here at the top of the slide, Phoenix is #5 city in the United States for job growth throughout the country. And it's one of 3 of the top 10 fastest rent growth cities. And in fact, it led the nation with the rent growth last year, even in a pandemic, up to 6.8% year-over-year growth rate. And then continues to have historically low vacancy for its units overall. And that absorption rate here, where they talk about absorption, for those who haven't done these investments before, that's how quickly units can be occupied versus new built buildings, right? So if you have an apartment building, but now you have a new high rise that gets built next to it with another 200 units in your submarket, absorption rate is how quickly do those new units get literally absorbed, meaning do they get occupied? And so having this 13-month pre-lease absorption is actually a pretty healthy rate. If you had things over sort of 24 months or certainly 18 months, you start to get a little bit worried that there's too much product and it would drive rents down. 13 months is actually a very, very healthy amount. The other thing that, as you saw from Elisa and myself and many of my other partners, we only like to invest where it makes sense. You can live where you want, no problem to live in California, but invest where it makes sense. Landlord and business friendly is certainly Arizona. During COVID, they still had their moratorium, but any non-COVID related causes are strictly not going to happen. So if you're not paying and it's not due to COVID, you've got your 1 month's notice and that's it. Furthermore, these are just some extra numbers going into the Phoenix market. You can see here that for the percent loss of jobs was very little. It's really a testament to the resiliency and the diversity of jobs throughout the Phoenix market. Just to give you an idea, I mean, some of the big employers, as we'll talk about in the submarket, that sort of 160 employers, there's big employers like Fujifilm, you've got Discover, Bank of America, Deloitte, American Express, there's distribution centers, right? Amazon, UPS, Dick's, FedEx, tech companies, right? ZipRecruiter, Opendoor, Zillow, all these corporate headquarters are all in Phoenix. And so it drives, again, where the jobs are coming, they bring the demand, people come, and now you've got that supply demand imbalance, not enough units in a affordable area and too many people looking for those units, continuing to drive rents up. We can see here over on the right side of the slide, that's that 6.8% year-over-year average leading the nation. And then we can go to the next
Now, I
slide.
want to kind of really highlight the median sales price per unit here. Take a note at this. It's $197,000. As we speak, this is so funny. As we speak, the price is probably going up right now. But 197K is the per unit price in that market as median. Our units is mostly studio, so it's going to be a little cheaper than this. But we're going to be buying this at 155K all in, including the capex and etc. So as you can see, there's already kind of value that you can potentially create from there. Cool.
Yep, and this is just an example of showing that price per unit, that PPU, right? You can just see that upward slope, right? It's continuing, and that trend's only going to continue as more and more people continue to flow out of California, as more jobs keep moving out of California and into Phoenix. And here's just an example. It's the 3rd top rent growth of all the major markets in the United States. And then we have,
and nobody wants to live at the first 2, right? Like we don't want to invest in the first 2 because the Inland Empire is like near the LA area, and the Sacramento is obviously California. So yeah.
And then this is just showing the net migration in, right? The green states are all the ones where there's inbound migration. You can see Arizona is the 5th most inbound migration in the country, and people coming from California. And then this is, again, just people searching for houses on Redfin, showing that most of these are out-of-staters, right? Over 90% of folks looking for housing are not from within the Arizona market, but actually people from outside of Arizona looking at housing coming in.
And then we always kind of look at Austin because Austin is the one that has tremendous momentum. But when you put it side by side with Phoenix over here, Austin is a phenomenal market to invest in. But you see, like Phoenix even have more searches from outside the state, which indicates a migration pattern. Obviously, Lane, our other sponsor, is not here. Lane's been pushing me to look for deals in Las Vegas. Maybe we'll have some in the future. Great.
So now I think we're going to go into the submarket, right?
Yeah. So it's an absolutely great submarket. The property is located in Midtown, which is really the living quarters for downtown. There's over 160,000 jobs in the local area, and as you can see from where it says Seventh Avenue Midtown is it's kind of like the epicenter of a bunch of new construction going in there, and they're really building it up and repositioning that area. Midtown has grown up. You'll see up to the north there where there's the Melrose district, and that's kind of like another entertainment district. That Melrose is kind of spread kind of into spilling over into Melrose. So it is, and then the Roosevelt Row is kind of like our art district. A lot of good entertainment, and they have a great thing called First Fridays of the month, where they do kind of everybody walks around and checks out different art studios and bars and just kind of hops. It's a little different with COVID, but it's still happening. It's still a happening place. The other thing, you were mentioning a lot of jobs as well. That St. Joseph Hospital is probably the main hospital in Phoenix, and it's right there in the center. It's a Dignity Health, and that in itself causes a lot of other physicians and other doctors to be right in that immediate area. And there's still a bunch of businesses and high rises all up and down Central. So it's just right in the heart of Phoenix. When you're looking at that word Phoenix and there's an O, and you're like right in the center of it when you're looking here. It's an excellent market to be in. The fact that we have the opportunity to be involved in El Cortez in in Midtown there, it's really hard to do. The market is so hot here that the second something becomes available in this submarket, it's gone. It's gone in hours. It gets eaten up fast. So this is a great opportunity to be in that living quarter for that area there.
Yeah, and then we want to really highlight that St. Joseph Hospital also have a 12-month nurse rotation program. It's literally right across the property. You can actually see it if
Mhm.
from that balcony. And then the Phoenix College also has 13,000 students,
Yeah.
which is right behind us, which, I don't typically buy studios, but that makes it actually a really great location for that, like literally 1 mile radius submarket over there. And of course, to our doctor Aaron over here, there's 6 medical centers within 3 miles radius over here too.
Yeah. And again, this kind of speaks to what's everything around there. I looked up the walk score, and I believe it was a 78. So I think that gives you an example. There's and the transit was I think at 53. It's on a bus line, so there's excellent transit. It's less than a mile away from the light rail system. Will take you anywhere from from North Phoenix down in through Mesa. So there's excellent transit in there, and they're extending the light rail. By the way, they're supposed to be going out to the Arizona Cardinal Stadium soon. So it's got really good walkability, along with all that employment. You don't have to own a car. It really, again, when you're dealing in studios, this kind of a situation kind of caters to that.
Yeah, and then within a block, like literally on this little corner, there's the Starbucks, there's Safeway, it's all walking distance, and there's also a Sprout, right? So Sprout, just like a Whole Foods, they do their marketing research, so you can kind of tell what kind of basis that we're looking at.
And that's all fairly new stuff. That's just part of as the area continues to get better and better. I know the property directly across from El Cortez is supposed to be hitting the market soon, and that's going to probably get rehabbed and help continue to fuel that market. The demographics, I think you kind of touched on it. You got the college right there, so there is some college. And the other thing is the medium home prices in the area are as that area continues to grow, the Phoenix home prices is what 477K. That leaves a nice big gap for rental opportunity. And again, it's another as hot as the multifamily is, the single family is. That's partly what's driving the multifamily is you can't come to Phoenix and just buy a house. If a house goes on the market within hours, they got 14 offers and it's above asking. So it's very competitive and it's also fueling the multifamily market.
Yeah, and then when you look at the almost 500K of median house, like a median family, single family home in 1 mile, that means it translates to about 2,500, $2,800 per month. And then our projected rent is about 1,000, which really kind of carves out that really affordability area. And then you can kind of see the education demographic. you pretty much have the whole pie chart that is higher degree than some college degrees. So that's a really great demographic. Um,
Speaking of the age demographic, millennials is a big part of that in the Generation Z. So again, it fits well with the studio concept. Is that's kind of it's a good setting for them to get into, and it's really going to help our rental market. So it's like a resort style living. It's the apartments, the pool area is absolutely gorgeous. When the name in itself, the branding, El Cortez, you could see the picture behind me and how it's done. It's literally it's class A interiors with the classy affordability. That is the best, definitely the best way to put it. What makes it really appetizing on a property like this is the newer roof. The biggest thing is the newer chiller and boiler. That is very expensive things if to have to replace on your own. The fact that it's already been done, and I personally have been in the boiler and chiller room, and the equipment has been very well cared for. Everything was very clean, very organized, and done right. Definitely done right. So the property occupancy is at 98% right now, and very little delinquency, even through with all the CDC that's going on. They don't seem to have been impacted by it. And there's been quite a few units remodeled, but still leaving a little meat on the bone for us.
Yeah, definitely. And there's about 35, 56 units specifically still ready to go. And actually, we walked, right, Anthony? Like, we showed up on due diligence, and Aaron
Mhm.
was there too. We walked, like, Aaron walked to like 25, 30 units or so. I did the
I walked
similar.
80 units. You kidding? Not. I
Yeah.
may have only done
Well, Aaron
25.
kept on
I did the full
walking,
house.
and I got distracted with other videos and stuff. So, but all among all the units, we want to show up to these due diligence because it allows us to see the tenant profile. And I would say after walking all the units, we all take these notes. There's basically only 4 units or so that we feel like was a little messy. These are maybe tenants that we don't want to keep or so, but the rest of the tenants are very high, like on a grade of different class of tenants, which is not typical of what we see. So that's actually a really great sign in terms of be able to kind of collect the rents and etc. Um,
The other thing is the current management there just isn't pushing market, and there's a lot of loss to lease that we could just come in and burn off, and that's going to create some immediate upsides.
Yeah, so a little bit of seller story I want to kind of talk about here is so how do we kind of get first hand on this? You know, it is a open market deal that we went a bit, but we actually had a first dip at it, right? So we actually saw this property a very long time. So when you have a very long lead way, two-way, you have a lot of preparation. Also, our broker is someone who have we have already closed the deal with, so there's some strong relationships in as well. And so that kind of helped us really position and landed this deal. So, but the previous owner is a equity group. So the model that they do is they're almost flipping apartments, right? And they're backed by a very big equity group in Austin. So these guys have a lot of money, so they actually would fix things and creating new chiller, boiler, do stuff that you and I would normally don't do in our class of enhancement. So they really fix the right bones and all that sort of stuff because there is cash to burn, and they usually buy property in cash because they're equity group, and then they put in a lot of renovations all at one go, but they don't pay so much attention because they want to do quick exit, so they don't actually do full expansion. They do a lot of lease up. So this property, after all the permits and all that stuff is done, only had like 6 months of like basically turning out all the existing tenant and filling it back in. So as you can see, you need to have a lot of concession when you do that, and that's our opportunity to come in and then really reaping the benefit of the previous owner what they did over there. Makes our job easy. Yeah.
And they did a beautiful job. I mean, again, you can see from the pictures you're showing, it's a resort style pool. I mean, you feel it's absolutely gorgeous barbecue area, nice sitting area that's covered, which is really nice for Phoenix. So much so, I think Elisa, you were saying that the pool water They play music when you're in the pool when they're swimming. They can hear it in the water, right?
Yeah, it's a little
Uh,
ridiculous feature. Like the maintenance guy told us that the pool actually had a speaker underneath the water, so when you swim, apparently you can listen to the music. We obviously couldn't verify it during our due diligence because like that would require an inspector to take a swim in the pool. So
there's also a fireplace out there, so just again, it gives you that resort feel. And then when you're up on that balcony and you're looking down, it is a very beautiful sight. And then the other thing is, and I really wanted to touch on this, is these guys didn't they did a very good job in the remodel process. They didn't cut corners, and they didn't use like sheet vinyl, and they actually put really nice quartz countertops in, high end appliances, not your cheap appliances. They put nice high end ranges in there, and microwaves, and it was a small space for them to cover, so they went all out. And it really speaks to the work that they do.
yeah, and then actually Anthony has noted that between the classic unit and the renovated unit, because the units are only currently rented for 960 at the top plus the rubs 110. So that $100 difference between the classic and the upgraded unit really creates a tenant difference between the classic and the people who actually stay at the renovated unit. So our plan was to continue renovate, and so this actually helps in terms of the tenant profile as well, to some sense. Great. So we're gonna be talking about the business plan a little bit more. So I'll be talking about the business plan and cover the rest of the presentation. Thank you, Anthony, for your local knowledge over there. So our business plans, as we kind of talked about this before, is we're actually getting a bridge loan on this deal. And then in Phoenix, it's kind of more of an equity play versus a cash flow play. Of course, any of our deal, we want to make sure there's plenty of cash flow from day one for us to kind of execute this, because this is almost a hedge against the recession too. But also in Phoenix particular market, we're looking at potential equity increases because, as you can see, that average vacancy is less than 4.5%. That's Phoenix all up. And then Midtown is even lower. That's putting in perspective. If you did invest in our Dallas, Houston market, usually you see about 10% in Houston vacancy rate, and then you see about 7 or 8% in the Dallas market, which is still very fantastic market. But in Phoenix, that 4.5 really expressed that there is a housing shortage in Phoenix due to all these explosive incoming migration. And what that means, if you have a shortage of housing, supply and demand, which is why it makes sense that rent growth is so phenomenal at 7%. And not only during the COVID, it was doing 7%, even the 2, 3 years prior to that, every year it was almost a double digit growth, at least 8% to double digit growth in terms of rent growth. And we've seen markets like this perform. In fact, I live in one in Seattle. A couple years prior, we see that wrong happens, and that create a phenomenal equity play in there. So, play along into this. Our business plan is almost chronologically like this way from the left to right over here. So we planning on burning off lost to leases, about more than 19% or 20% economic vacancies. So when I say 19% of the units, it really mean economic vacancy. Yes, we're like really almost fully occupied over there, but what it means is because all these lease up was done quickly during these like 6 months, the previous owner has left a lot of money on the table, right? Because they have to put in concessions in order to get the people in batches move in. So hence it leaves us like $50 to 150 per unit in terms of moving that up. So that's going to be easy money, and that's going to be what we do. We have done lease audit, and so there's a plan to continue kind of burn that. And then actually, the studio nature in this case, the turnovers really help us doing that, because studios usually have a retention rate about 1 to 2 years, after which the tenant moves out. But in this case, the more people move out is actually better for us because it allows us to kind of realize that loss to lease, which means charging the market rent. And we're planning on adding a high-end gym. Right now, the tenants has access to Fitness Planet. It was included as a free membership for them. But it would be really awesome on the entryway. And we have a video in our email as well, the 2-minute video. You can kind of see that and think about the space. Is as soon as you walk into the door, we want to put in a high-end fishbowl style gym equipped with Peloton, which allows the tenant sets the tone for lease up because the lease office is right beside it. So tenant comes in looking for a bargain. They're like, oh, we're coming to almost a class A property. So kind of sets the tone with lease up. And then we do plan on install wash and dryer. We're actually, in my underwriting model, I use actually $50 per month per unit on the premium, but we're pretty sure we can get $70 even higher because I'm already achieving $75 per unit at Oak Tree, this other property that we own in a much like more of a C class location, whereas this tenant will be able to kind of afford a little bit more. So wash and dryer, that was almost a surprise for us. I don't think our seller really did a lot of digging on it. But our inspector were really confident that we could actually add a wash and dryer for very efficient, like the structure is really kind of supporting that. So we also have plans to upgrade the remaining 56 unit. This is going to be just as the tenant kind of move, we're going to do that. So, not until we implement all the loss to be leases and all the other stuff, then we'll start looking at some upgrading of the units and etc. And then the good thing is everybody's always talk about lumber being like very expensive. So we're going to be smartly managing that. Obviously adding washer and dryer, we're probably going to prioritize that because there's not a lot of more lumber involved in that. So there's a couple bonuses that we didn't put in the underwriting, which we have included in here. One thing is providing valet trash services. This building is 3 floor high with elevator. So for a tenant to kind of haul all the way their trashes from 3rd floor or 2nd floor through elevator to the back of the building, for sure some tenants are not taking their trash out as frequently as they need it. So this is almost like a need and a service, a value for them. This is gonna allow us to charge some valet trash for conveniences, but also is going to eliminate some of the pest control issues that we have in the building because the trash are taking out more frequent. You're gonna have less issues with pest control, which saves some cost on pest control expenditures. We're gonna be also bonus on this is definitely a bonus. We don't count this in our underwriting, but we did include expenses in there. Is we have our goal. This is a fractured condo deal, so there is 5 unit that's not ours in the building. So it's 165 units total in the building, and we own 160, and there's 5 condos that is individually owned. A good thing about that is these 5 condos are the only handful, literally five out of the 7, 1 bedrooms over there. So that actually commands a higher rent per unit. And then so my broker, who's very excellent, is going after these 5 condos right now as we speak. He's already signed up 1 out of 5, so 4 more to go. And there's some efficiencies in terms of that. We underwrote it as a bonus. We did budget in for future costs. So our lender did approve for future purchase and leveraging all that sort of stuff. But by including these condo, it's going to achieve an efficiency in terms of expenses as well, because we're going to be able to dissolve the HOA, which will reduce a lot of inefficiencies in the expenses because there's extra fee, there's extra reserve that you put in HOA. It's actually a pretty big number, the $40,000 annual saving. And in fact, that saving is going to be bigger because I just talked to the insurance guy. The insurance is relatively high on this building because you need to have 3 policies on a deal like this. Not only covering the HOA association policy, you gotta cover the individual condo interior policy, and you need a director of the office insurance. So it's relatively high insurance, almost double. But by eliminating these 5 additional condos, dissolve the HOA, we now can use the regular insurance, which because they're all studios, it's going to be way more cost efficient on that. But these are bonuses. We didn't put that into our underwriting. We still use the very high insurance in our underwriting. So, and then we trust our broker in this case and be able to finally get them eventually. But we can't underwrite it in because it's a not done deal. We are going to be I'm really excited personally. We're going to be able to install some solar panels Most times solar panel does not make sense because it costs a lot of money to install. And if it's individually metered, your tenant is paying for that electricity. But in this case, I think we just found a niche, which is this building is an all bills paid building. So hence it has chiller, boiler, all that sort of stuff. And the all bills paid building usually doesn't matter how much you charge back to the tenants because it's per market. You're never going to be able to balance the expenses you spend on the utility. So it never covers your cost. So in this case, it's perfect because then we can install solar panel and reduce electricity by 60%. And that's about 50K of annual saving, which affects my bottom line. And the tenant will still be charged the same amount. All these bonuses that you saw up on the top, they're not going to know a difference between, they're going to be still paying the same amount. But the difference is because we shaved off that 60% from our cost, now we're actually providing more services to them. So more value to them with any increase. And also to us, 50K of annual saving is about a $1 million valuation increase. So you're spending about 500K to do the solar panel installation. You get some minor tax credit as well. You save 50K, that means it's about $1 million valuation increase based on the 5 cap rate. And then also, lastly, I think Anthony is probably unhappy about this one. I mean, he's happy about this one. But it's probably the least favor of his is that he's giving up pretty much all his PM fee just to cover costs, that 1% cost for regionals and etc. To help us kind of achieving more efficiency. So that is controlled expenses that we're reaching the efficiencies on. Cool. So this is our CapEx budget. We just kind of include it in here. We have plans to do interior units upgrade. We may not do all 56, because it may not be all available to us, but we included that, and this is all funded, approved by our lender. Majority of this are. And then there's future funding. So about, I think the lenders approved the 72% LTVs on the initial purchase, and they cover 100% of the improvement of these 5 condos. And then there's wash and dryer, solar panel installation, the gym. We budgeted quite a bit money for the gym. We may not need to use it, all that. And then we also looking to add a dog park in the back of the building, because to encourage pets in the building, and which pets means we love pets because pets means more rents. And then there's cash reserve. So this cash reserve is we raise ourselves, and there's the contingency. So lenders giving us about a 3.3 million for all these capex, and then we also have just cash on hand, the 800K of cash on hand. For some folks who has invested with us on our previous projects, you realize that this is one of the signature that we do. We like to have a lot of cash on hand. So when it comes to rain and shine, we are able to sustain our property, which make a less risk of investment for us. And okay, so I include a slide of solar panel because this is probably a less common known value add that you're familiar with, just to kind of demonstrate how this works. Should we not sell this property and continue hold it? Obviously, you're not going to realize that valuation increase, but you can realize that on the refinance because this 50K does hit your books. But should you not refinance and not sell, which is very impossible, like the break even for these cash returns 9 years to just pay back what we have spent it over there. There's also some tax credit, minor tax credit. It's nominal in general things. It's probably like increase the K1 by about 5% in terms of negative K1. And it's treated the same way as the other. One is tax credit, the other is depreciation. All right, so we're going to be talking about a little bit about the rent comps. So rent comps is something that we always do. This is how you know if your property has potentials. So as you see, as El Cortez stands today at $951, this is updated units. Over here, and the classic at 860. Really, the 860 is the bottom of the barrel over here. So there's definitely rooms to improve. And the property right beside us has Metropolitans literally right next to us. It's an older building. The units are all classic, so even they are charging more than $900 per unit for this. And really, it's an old building, and then the 390 square foot, not a comparison. And this is wrong from Yardi when it's pulled. It is actually a 60s building, but probably last renovation registered in Yardi is the 85. Yardi actually doesn't even have an updated picture for this, but they're very accurate with rent comps, so we're gonna take that. And then as you can see, there's a lot of upside in terms of Phoenix and other product. This is where the room that we're going to, and then 1025 plus the rub is kind of what we're targeting. And when we're looking at these things, we also needed to see the all up, right? So the Class A amenities over here, they're going to be charging a lot more in terms of rubs and other fees, about $200 to $250 averagely. So that is additional compared to our 110, other services that we charge. And here's another comparison. Studios by square foot is just a different way to slice the data. And as you can kind of see, we have a lot more units and a per unit price. Like if you look at the per square foot prices, again, our Cortez is ranked pretty low over here. And I did a graph on this as well, which kind of shows the pro forma rent, which is in our underwriting over here, and then our classic rent. Like this is what we think it's gonna be moved to, and this is like what the classic currently is. And as you can kind of see, from a price per unit wise, they're kind of there. But again, Metropolitan is about 50 square foot 50 to 60 square foot smaller, these units. And again, Metropolitan is a classic unit, so it needs to be compared with the classic. So there's a lot of room for us to move. Again, I couldn't find a lot of comparables over here. But and then Dual is a micro unit, which has less than, I actually thought about buying Dual. We were actually in bid for that too, but they have a unit size is smaller, 250 square foot as well. So, the per price kind of put you just to show like where we at. And then here's kind of really a telling graph over here is price per square foot. And then as such, Dual has the highest because it's the smallest unit. And that's typical smaller unit. Usually they have a little higher square foot. But Metropolitan is actually smaller than us, but lot higher than ours classic because you're gonna do comparisons that way. And then, when we talk about the Pure is more of a Class A product, but this is kind of like, in addition, their per square unit foot is like a $300 than ours, right? So this kind of sets the tone of where you have. So like we want to look at the data, slice it different ways. All right, show me the numbers. So I like to kind of put the fees and all that stuff up in the front, just kind of explain it. Again, third party PM fee, usually it's at the 3.5%. Anthony is only charging us 1%. There is an asset management fee of 2%, but we do plan on accrue this until all the investors' pref rates are being met. So again, putting investor first. There is an acquisition fee as well of 2.5%. And then there's a sponsor compensation, and just kind of show this as a split over here. This is more the back end split on the cash flow split and the voting rights and the 30/70 split. But we're going to pay the Class A first, and then B and C, and then the Class D is going to have a catch up to their share. And then back to Class A if there's excess, excess cash, we're going to go like, let's say a refi scenario happen, any excess cash then goes and pay off the Class A. And when that event happened, the Class B and C, their equity share is going to increase in value drastically. And then your cash flow will also increase as well. So that's kind of how we run these deals in different classes. And then these are some IR. I'm not going to repeat them. They're kind of repetitive with what we have before. Specifically, I want to highlight we are getting a non-recourse loan at a 75% rate. And then this initial capital is basically what we landed out here. But I think our loan proceed is a little bit higher. Actually, it's almost $1 million higher than here that I listed over here. So, we probably only need a $9 million or so. And actually, our interest rate we already got better. The deals already got better from our initial underwriting. The interest rate that we finally landed on, the 3.5% on bridge loan, it's a floating rate though. So it's about 3.35 off the 15% LIBOR floor, which is really great. And this structure is actually a 2-1-1-1-1. It's essentially working as a 3-1-1-1. I thought I updated this. I don't know why auto formatting has messed it up a little bit. But what it means is the first 2 years, and I have a free extension of 1 more year. The reason why they structured that way is to make it more flexible. It's actually better for us. And then you have additional 2 more, so total 5 years. You have additional 3 years extension. The first extension is free, and then the consecutive 2 extension will have some requirements on exit. But likely we're going to be, refinanced into a permanent debt or sold the property. There's no prepayment penalty. Actually, there is prepayment penalty if we exit within 15 months, which I don't think we're going to finish the project in 15 months and stabilize it. So, no worries over there. There is a loan origination fee of 1%. And there's no exit fee on loan exit as well. So it's a very great term that we got. So again, this is a highlight of what do you got as an investor. So as a reminder, Class A's are fixed rate return at 11%. You do participate into the bonus depreciation, the negative K1 we talked about before. Again, it's great self-directed IRA. And then if you're someone who's older, who think about retire, you don't have to be older, you're just ready for retire. This may be a good class to invest in. And we allocate about $2.5 million for this class. So this one's probably going to go fast on this deal. And then there's the equity investor, which is B and C, our traditional way. You participate in the equity upside. You're still going to be getting a 7% pref rate, which is pretty phenomenal for the Phoenix market, which is typically not really high on cash flow. And then for Class B, the minimum is 250K. It's 25-75 split in the back end. And then for Class C is 75 minimal, 30-70 split. Great, which turns into a 15%, 16% IRR. And this is kind of the number when you compare with other types of investment. Okay, so this is a graphic way we include this in our presentation. We're not going to go through them. We did put Class A as 2 to 5 years because I'm pretty darn sure that on the second year, we're going to be able to give back the Class A money, a third to half of it. So a third of the Class A is going to be paid off just from simply these cash reserves that we have created. As we do renovation, the money comes back from the lender. Then we deem that the cash reserves will no longer need them because the money is coming back to us. Then we can pay off our Class A as soon as we can. Okay, so this is just kind of a visual model how you will get paid. And then this is a visual model how Class B will get paid. And then a visual model how Class C gets paid. So B and C likely going to be in there for a little longer. Okay. And this is a 5-year projection. Don't focus too much on this. Remember the washer and dryer I kind of talked about before. The plan that we have is a slow ramp. So we're going to be implementing a quarter of the wash and dryer year 2. In first year, I didn't put in any income increase for the washer and dryer because we may be waiting for permits. Never know. So on the second year, we included a quarter. Third year, we included a quarter. And fourth year, we included a quarter. And we left another quarter out of the room, assuming we can never get into these units, can never do this. So there's room in this. And then we also use the $50 per unit in our calculation, which translates to these increases on the other income. And I want to kind of call your attention to these yellow highlighted cell. Like at the end of the day, I always look at what is the total income increase. It can be coming from the other income. It can be coming from loss to leases. It can be coming from reducing vacancy and all that sort of stuff. But at the end of the day, how aggressive are you with total income growth? Right. So for me, this is a value add project, and there's a lot of loss to lease to burn. But in general, we like to kind of delay our projections a little bit more over here. With bridge loan, we have the urgency to finish majority of our renovation as soon as we can, because otherwise the money kind of goes away. So there's definitely opportunity for this to be shifted more towards the left, because as you saw, even though the property is 98% occupied, there's 19% higher loss to leases. So right away when Anthony's taking over, on new leases, they're going to be pushing that. And Joanna's probably going to be on this. She's our regional on Harlow, and she's achieving $200 to $250 premium on our Harlow property with no concession right now. And then we're getting some tenants that has credit scores higher than mine, and mine is pretty good. So, so, and then the other thing I want to call out is the DSCR, which is the debt to income ratio. This basically determines the likelihood of you be able to service the mortgage. And then anything above the 1.5% means that you're in a pretty safe zone. That means you can serve 1.5 times the mortgage, right? So put you in the ease. So we're at a 1.6 out of go, mostly due to the expenses, and thanks to Anthony for waiving his fees on that stuff. Um, and then also the cap rate. So again, guys, we're in the midtown area, so we're really talking about the core urban core. In this market, we pretty much never see it goes below 5%. Sorry, above 5% with cap rate. And then if we're entry at a 4% with all these loss of leases, we're projecting an exit with still our traditional 1% gap over there, which is a pretty big gap on the cap rate. And we have a slide later on kind of talk about that. And this is a slide we kind of prepared on like just the rent growth in general. This is the national is at a 1.2%, right? You kind of look at this and lifestyle, it's almost negative. But then when you look at Phoenix, like this is pretty big, all asset types. And then, when you look at Phoenix on rent by necessity, which we kind of belong to, we're like at the top over here. So this is like the big gap we're kind of talking about here. And then the cap rate I just mentioned before, we always like to show you what does that mean, cap rate sensitivity. So cap rate 1% is a huge gap. And then this demonstrate the example. So we bought the property at 4%. Very likely we could have exited at 4%, right? So we bought the property at 4%. We could exit at 4%. If we do, we're almost close to a 200% return, like 170, 180% of return. So we picked something more conservative, and this market pretty much will never go above 5.5. I would say even above 5, really. And then you can see the downside is somewhat capped. Even at a 6% rate, you're still making money. So that's something important to remember. And remember that median price 197K a door right now. Again, we're buying this at 155K a door. All right, so tax savings to equity investors. So I want to just have a very high level explanation what we're trying to do with tax. This confuses people all the time. So I want to spend about maybe 1 minute to explain this. We have videos on website to kind of talk about this. There's 2 or 3 hours of videos on this, what cost segregation is, how you're actually applying it, who qualifies, and all that sort of stuff. But basically, a rule of thumb, if you have a W-2 job, your ability to take advantage of this is somewhat limited. It's deferred. Likely is when you exit the property when that majority of the depreciation is getting applied to your gain, capital gain. But however, if you're a real estate professional and that spent 500 active hours on active projects like me, Anthony, or Aaron, then you can potentially reach a ability to use the negative K1 that we give it to you to offset your active income. Consult with your tax accountant CPAs for all that advice. We're not professionals on that. So how do we actually generate the negative K1? And what is negative K1? K1 is a form that we give it to our investors. So we're going to be filing a tax return for you for this property. And that's going to be a partnerships return. And we because this property is in Arizona, Arizona has a small state tax as well. So we're going to be taking care of that through a composite file return. It takes more time to do it, but we want to make it easy for our investors so you don't have to worry about filing separate tax returns for Arizona state. So basically, a cost segregation study is so let's talk about depreciation first. In a residential property, which multifamily is one, it basically said you can take anything that is diminishable, like land is not included, but building, interior building, etc., is all depreciable. And typically, if you take a linear depreciation, which means that you're deducting that loss as if at the end of 27.5 years, you lost all the value on the depreciable asset of goods. And then you take that loss over 27.5 years linearly, and every year you get a little bit deduction consistently. So we actually hire a cost segregation engineering team to come in and do an examination of all the interiors, all the buildings, everything. So why do we do that is because not all asset is depreciated 27.5 years. The fridge, the flooring, sometimes they only last 5 years by IRS standard. So why are you depreciating stuff that's already gone in 5 years over 27.5 years, right? You can depreciate them in 5 years. You can depreciate them in 15 years, 10 years. So there's a whole IRS code. What is depreciation and like how long these lifespan is. So imagine if you're able to depreciate something in 10 years span versus 27.5 years, that means your depreciation amount is almost 3 times more. So this is where the cost segregation engineering comes in. Do all the study, they will tell you what is life left in these asset. So and then reduce that years of the basically the age left in that product. And then you can take depreciation a lot faster. So it facilitates into what we call accelerated depreciation. We gave the study to our CPA, and the CPA says, "Oh, great, you can like have a bigger depreciation." Now, due to the 2017 changes in the tax code, there's something called a bonus depreciation, which means you can take all your depreciations from your year 5 to year 15 in the first year, which is fantastic. So think about some assets going to be otherwise linearly depreciated 27.5 years. You're taking all that and give it all the negative on the year 1. And that's how we use it to generate the negative K1s for our investors, even though you're investing in something, even though you're getting returns on something. Cool. Hopefully this concept is clear as mud for everybody. Again, don't worry about it if you don't understand what I just said. There's 2 or 3 hours of videos and we can kind of point you to listen to. And actually Aaron has a really good, anecdotal on this because, he's a doctor. So Aaron, do you want to kind of talk about how you actually use this depreciation?
Well, I can, in some regards. I mean, I think the biggest thing that one can think about cost segregation studies and why bonus depreciation helps is that, like what you'd mentioned to and alluded to, when you take a linear deduction, if we were to take just that 1 year at a time, we would only be able to take the price that we're buying the property, that minus the land. And we'd only have about 3.6%, which is that 1 divided by 27.5, to be able to offset any taxable gain along the way. However, because of this cost segregation study, where literally you're segregating a building into its parts, right, into all of the different components, right, the flooring, the fixtures, everything else, by putting all of that to year 1, we're now able to now take that sort of 40% or almost 50% of that cost, and so now your K1 becomes quite a bit negative. And so for an average, say, $100,000 investment that's going to be put into this property, that first year K1 is going to show minus 40, right? So minus 40,000 is going to be the negative part of your K1. And then whatever your cash flow, say if we're able to distribute the very first year, maybe 6% of that preferred 11% to one of the share classes, well, now you've got 6,000 on this mythical, sort of return, minus 40,000. So how much tax have you paid off that 6,000? The answer is 0, right? And so the more that these investments that I have and my wife have done, where we've got this income that's coming in and yet we're paying no taxes, that's still money that's in your account and you're not paying tax for it. And so as we've built up our portfolio, you start to see really big swaths of income coming in. You're like, wow, that's stuff that we can pay for eggs or all these other expenses. And so it's allowed me to cut down on my clinical hours, because the amount of money that I have into these differing investments, and because it's tax advantaged, again, you have income coming in, but the K1 showing a loss. And that's because of this cost segregation and bonus depreciation. And so it allows myself, other clinicians, and certainly other people, it's not limited to physicians, but just an example of being able to not just earn income through your W-2, but really seeing how this is a much more tax advantaged way than getting hit at ordinary income rates, which if you're in California, it's the 37% plus another 13% plus.
Mm-hmm. And it kind of applies to high income individual, and there's other tax strategies. You should really talk to your CPA and see how you can maximizing this. I have an article about my personal experience of paying almost 0 taxes on their returns because due to syndication activities and all the other stuff. Cool. All right, so want to kind of wrap up our presentation. Why do we like this deal? To just kind of summarize it up. Again, very highly desirable B plus location, a highly growth market in urban core. We're right next to where there's demands of studios, like the hospital that has 12 months of nurse rotations and the colleges and all the other stuff. We have more than 160 major employers in the surrounding area. We're in the midtown, where it's next to the downtown and all the other place. There's sum it up. There's about 140, 150,000 jobs right around us. Very diverse. Median household income in 1 mile is above 58K, which is really great. And the A-class interior amenity, which gives us really a unique edge on this property. It's almost a showpiece. So if our passive investor, you want to, Anthony's team is in Phoenix. If you want to, you can always kind of take your family and friends and come to our building. Make appointment first, please. And reach us to first, and then taking some photos if you want to. So really kind of a showpiece property that we were able to, lucky enough to kind of get our hands on. There's very little deferred maintenance due to all these work that was done by the previous seller. And then also cash flow from day one, specifically focusing on a PM fee structure and things that is controllable for us. It's a very low risk plan because, again, we're focusing on the lower expenses and burning off loss to leases, which is already there. The value is already there. So there's not a lot of huge risk on physical value add. And then creating a win-win situation, just what I like the best, that allows us to kind of really think about positive in terms of harvesting green energies to help the planet a little bit on this as well. So, and then lastly, of course, people. It's really important to invest with the right people, experienced vertically integrated team. So the way the role that we're going to play is we only have 4 players on this, right? So Ling, me, Aaron, and Anthony. Anthony and I will kind of oversee more of the day-to-day asset management and that type of stuff. Anthony obviously looking at the property management stuff. And then we have Ling kind of audits, looking at investor relations, and then Aaron is looking at like a tax stuff. Aaron makes sure that I don't miss anything, so he's very detail oriented on all that stuff. And then all 4 of us will sign on the loan and guarantee it, and we will invest ourselves as well. Cool. So acquisition timeline, what do you need to do? All right. So our portal is ready. And we're going to be sending out an email tomorrow morning, just to be fair for everyone who didn't have a chance to look at this. So tomorrow morning, we'll be sending out an email to everyone with the portal access. So you will be coming, even if you reserved, do the same thing. You will click on the offering inside of the portal, not the reservation, and then start filling out the documents and ready to go. Our bank is taking a minute to open their bank account. Wells Fargo, I mean, we bank with them, but they take a minute. So, our funding, I'm hoping it will be ready to accept funds next Monday. Also, my assistant is traveling right now, so I want to make sure my assistant have time to monitoring all that stuff. So you will be, once you submit all the document, etc., it will take 24 to 48 hours for us to review. And my assistant Cassandra and Christina, and possibly me, will be reviewing all the documents. So everyone in the Easy Real Estate Rocks part is going to be reviewing the document. And then once we approve it, you will be receiving a wire instruction through a text or email on this. We're trying a new process in this, so we're using our portal, secure portal, to also publish our wire instructions. So by the end of your subscription package, once we get the wire instruction, you're going to see the wire instruction only after your application, you sign out a ppm, etc. And then sometimes when we have situation when there's overfunding that's happening, for our last 500K, 1 million, for our last investors, you may getting a more manual process, this specifically so that we can control the incoming wire. We never want to have to refund you because we were full, all that sort of stuff. So you're going to be either contacted by my assistants or me on wire instructions, and Cassandra and Christina or Elisa. If anyone else, don't answer them. And then so we're going to make it this as easy as possible for you for funding. So funding will likely start next week, Monday. But the subscription document's ready, and we actually have already $6 million interest on this already. 6.5 potentially. So you definitely want to fill your documents really fast if you're pretty sure you want to invest in this. All right. And we expect about actually June 24th for closing, June 23rd, and just to kind of give a buffer day. So we expect about a week earlier to be fully funded. So if you're asking us, when do we need to fund this? Like, hey, as soon as possible. And then you definitely don't want to be the last people kind of struggling on this. And your spot is not secure unless if your money is wired, and there's also first come first serve. The larger amount has priority if it comes down to it. Great. So that's pretty much it, and we're opening the floor up for Q&A.
So one of the things that came up in the Q&A, I answered a bunch of the stuff, but one of the questions as you review the Q&A here, Elisa, was first, I'll just go through all the questions again
Yeah.
anyway. But what's the main demographic of the current renters in the apartments, students or employed, right? And so it's definitely not student housing. I mean, our lender wouldn't even allow us to have it be student housing, but there are a few students, but it's young professionals.
Mm-hmm.
Yeah, the college that's there is it's Phoenix College is a community college. There is a campus downtown for ASU, U of A, and NAU. They all have their spots downtown nearby, but yeah.
Yeah, so I'm trying to go back. Actually, I want to kind of correct one more thing. Is our closing? I put in our presentation. Our closing is July, because we always have these 15 days extension to extension built in. So the latest the closes could be July, the end of July. However, our first, our without extension will be closed on June 24th, and then right now there's no indications that would not close at the time of June 24th. So we always say early closing just to set the right expectations. That's why in our deck we talked about July closing just to be kind of on form, but definitely want to fund before June 19th, so the money actually make into should we actually close early. Okay, cool. So I want to definitely go through all the questions. I think Aaron just went through what is the main demographic current renters of the apartment. Various. We don't actually have students on our roster, even though we're next door to a college, and this is due to lenders don't like students in the building. So we're gonna be kind of taking some control measures over that due to COVID. And so it's young professionals really what we have. How much do you plan on increase the rent? We talk about, I think Aaron answered over here, basically the classic unit, we're gonna hike up the price to almost close to the updated. The need is kind of do a positive return and actually getting that unit back and renovating it. So from the classic to upgraded, there's $100 difference in there just today. And then there's about $50 additional from the top of the market in that building for the updated unit to be lost lease to be burned. So our performance is a 1025, I believe we can get to, plus the $110 rub. The rubs at various from $60 to 110 right now, and there's certainly a demand for 110. And the property is already renting at 960 on the late leases at 110. Nobody's even batting an eye at that, so that's an indication of there's more that you can kind of, we haven't reached the ceiling. Is there additional insurance cost for the gym? Yeah, yes and no. It's kind of covering the liability, so there's not a huge amount. It's nominal. At some point, can we review how the condo acquisition works? Are they more per door? Do they off? Okay, so we own 160 units. So you should just think about that as an apartment. It threw me a loop when I first looked at it. I was like, oh, how do I think about this? But it just think about it as you're buying a 160 unit. The only additional things that here is the HOA. The HOA is a huge inefficiency on the operation because you have to escrow the money into the HOA and it holds it. So more cash it's holding, it's money off your books. That's inefficiency. So it's kind of expensive, even though the money isn't spent. So that's where that inefficiency comes in. There's also a third party fee to hold that HOA, and there's legal fees along with it. And one of the biggest inefficiency is insurance. Insurance will almost double because the fact that you have this association and you're actually doing an interior insurance for all your condos over there. Everything else is pretty much the same as the apartments. So what you needed to do is when you buy the condo fraction, once we got these 5 units, we make a whole, then we dissolve the HOA. That's kind of how you think about it. And then no difference because you own such a majority share of these condo, so it's no issues getting lender to buy it on it as a single parcel to kind of buy. Cool. All right. So bonus depreciation will remain in place at least through the end of 2022. If that depreciation were to go away in 2023, does that impact? No. So we're gonna be generating that negative K1 in 2022 tax, no, 2021 tax year, which will be filed next year. So that's already kind of baked in. And then should it go away in the future, that just means the other new buildings we buy, we cannot do this anymore, and it doesn't kind of pertain to this one because it would be grandfathered in. Okay. Okay, so I think Aaron was talking about it being phased out. Again, like check with your CPA on all that. And everybody knows there's a huge tax, revamp coming up with Biden law. And then even if you ask the best CPAs, they couldn't tell you what is exactly is going to shake out to be. So there's a lot of changes over there. My CPA has been told me, he's like, well, you may want to think about 1031 because who knows, like maybe on the chopping blocks, right? So, but again, every investment time changes. Should all these tax benefit goes away, that's not to say the next president's gonna not put them back. So you roll with the punches in these. Okay, so in Class A, 11% is a preferred rate. Yes, it is a preferred rate. However, we only have $2.5 million allocated to this, and our cash flow will support it. And I think Debbie asked another question in the chat box. Like, try to put your question on the answer if you can, so we can kind of make sure we don't miss it. But she asked, what is the break-even point? I love this question. So what is the worst case scenario percentage of tenants for loan to be continued paid? So I ran a stress test on this. We need to be at the 45% economic vacancy in order to not be able to pay the loan, and not be able to pay what? No, we'll be able to pay the loan just about, and not be able to pay the Class A, B, or C. Nobody gets paid. And then we have to be at a 35% economic vacancy in order to not pay full amount for Class A. So this is kind of speaks for the secure level of our Class A's in terms of the fixed rate return on cash. Cool. So hopefully that answers that question. Okay. Aaron, I don't know if you kind of been scouting the chat box one. I don't want
Yeah,
to.
there's two more. I just, since you were toward the end, I didn't answer them, but they said, what's percent of the sponsors are putting cash in? Right, so we've got 10%
Yeah, we're gonna put 10%. So
of
that's
the equity piece.
700. I mean, we already have 500K. No, we already have 600K in, just from like all the earnest money, the application fees, and all that stuff involved in here from the from the GP, and then we're gonna put more in there as well. Okay, so other question. Oh, thank you, Aaron, for remind me. Yes, you can blend it. Sorry, I didn't say this. You can blend between A and B or A and C if you want a little bit from both. If you want to diversify your investment within a single investment, you could kind of blend it. So you get some cash flow from the A, and then you get some equity from the B, or cash flow from A, then equity from C. You can blend it as long as combined you meet the minimum requirements. So you can do A and B for 250K, or you can do A and C as long as combined and match 75K. Great. Okay. So any other questions?
You had a few more that just popped in the Q&A.
Yeah, so yes, Victoria wasn't, yeah, it wasn't a typo. It is a July closing. I want to just explain that. We always put the latest possible closing over here to set the expectations. But there is a very high, strong possibility of early closing on June 24th. Um, Great. What percentage are sponsored? Okay, so we answered that. And then the next question is entity eligible for 1031, assuming it still exists at the time of sale. The entity itself is $9 million, $9.5 million is going to be a lot of investors, around 100 or so, I would say estimate. So to move everybody into the next deal is going to be a huge undertaking. So we don't typically do that because it requires to retain 50% of the investors. That being said, we could always explore it, but I want to set the expectation as no, currently not. But in the future, if I did figure out a way, we do not rule this out of the possibilities, but typically this size we do not. Okay, so if one investor through a self-directed IRA, the negative K1 depreciation cannot be used in any manner. So yes and no. So if you had other gains within that same self-directed IRA, they can that lot passive loss gain, then you can use the negative K1 to offset that. But in general, it's much less efficient than than cash, because you can't use it to offset active income. Should you be a real estate professional that spends 500 hours on active projects, so it's not as useful, but it can offset within the same class like solo 401k by itself or self-directed IRA by itself. But largely, if you're a real estate professional, then you probably want to invest it with cash because that, possibly offset your income there. Again, talk to your CPA on this because everybody's situation is very different. I would hate to give you the wrong advice due to the fact that I don't know all your situations. Cool. Can I use defined benefit plan for Class A investment? Aaron, do you know what a defined benefit plan is?
I do, but typically defined benefit plans, I don't think, I mean, this is not taking in ERISA funds or other types of funds like that. It's not eligible. Typically, they don't. You do have some choices in a defined benefit plan, but this is not the kind of investment that they typically that would be able to be taken from there. You could borrow from your defined benefit plan and then invest here and then pull back, right? So you can there are people that even borrow from their self-directed or their other IRAs, right? Because you can borrow up to 50K, for example, to use whatever, and then pay it back over 5 years. But you cannot directly invest out of a defined benefit plan that I'm aware of.
Got it.
Usually,
You can't invest in any classes that we offer with solo 401k and self-directed IRA. Um, I don't know what a defined plan. Clearly, Aaron has a much better idea with what that is. It sounds like it's some sort of that type of retirement fund, but not exactly self-directed IRA and solo 401k. Yeah. Okay, so if you blend A and C, then one has to specify how much is towards A and the rest will be C. So the payouts will be in the same proportion. Yes, yes, very simply put. In fact, when you go on our portal to do subscription document, you will actually fill one out for the A and you will fill another one out for the C. That's due to the limitation of our portal software right now. But basically, you own a share in the A and the C. So it's, to us, it's almost like two separate people, even though, you get the same in the same account. Yep. Great. I think that's all the questions we have. So we don't have any other questions. We're gonna adjourn our meeting. We're we're only 6 minutes over, which is pretty amazing. Consider we taking 2 hours on previous sessions. All right. Well, if you have any other questions, let us know. You should be receiving an email from me and Aaron to you tomorrow morning with all the links on, basically the subscription package. So you can start filling your documents. Definitely don't wait on that. If you know you want to invest, definitely want to fill the subscription. If you're not too sure, don't fill the subscription. But if you're sure you want to, don't wait. Definitely get that done. Like I said, currently we already have soft commit over $6.5 million. So this one's going to go quick on that. Perfect. All right. Well, thank you so much for joining us
thank you,
such a
everybody.
late time. And then, we hopefully you have a great evening. Yes.
And just let us know if you have any further questions. You guys know how to reach me. Send me an email, text, whatever, and we'll go over any further questions. Happy to help answer.